Live stream training. Today, we are going to be talking to you about documents that you need for funding your business. I will be your host as Ty is getting ready for the business, our Funding 30 challenge. My name is Keith. If you have any questions, feel free to jump in. Feel free to leave me a comment. I'm watching those. I've got my team available to answer any questions. So today we're going to be talking about documents you need for funding your business. Getting business loans is great. It's awesome. But before you do, there's some things that you want to get in order, and that's what we're going to help you with today. Before we get started, if you need money for your business, Funding 30 Challenge starts Monday. We've got over 20 lenders already mapped out. It's going to be an awesome time. We've got 20 lenders mapped out. We've got over 30 different options for funding. We've already got hundreds of people in our exclusive Facebook group, just ready to get going, ready to get things started, and they're already having a party sharing ideas in there. So if you haven't registered, you can check it out at funding30challenge.com or creditsuite.com/funding30. And we'll have the link in the chat for you here in just a moment. It's always an awesome time. This is our fourth event, and it's just awesome. You're going to have a lot of fun when you join. So let's get started. So documents that the lenders need. So the first thing to understand is what lenders are looking for. This is really what we're going to be covering today, is talking about what you could be doing to get your business ready, what steps you can take to get prepared, what documents, kind of the technical setup and the technical strategies of what you need to be able to get funding. The first thing is get prepared before applying for financing. Without making sure that you're fully prepared, you can't really get an accurate pre-qualification. So if you're going out and you're looking for a loan, if you're going out and just kind of kicking tires, talking with lenders, trying to figure out what's available, what's there, if you don't have an accurate picture of exactly what you're trying to accomplish, where your business is at, where your financials are at, you're not going to get a proper pre-qualification. And this could have adverse effects on a couple sides. Without an accurate pre-qualification, you can be denied, just hands down. And the other side of it is without accurately knowing where your financials are, what your documentation looks like, having all this stuff in order, not only can you get denied, but you may be missing an opportunity for even more financing that would be available to you. So that's what we're going to cover, is just helping you prepare for that and getting everything. Because at the end of the day, my goal is to prevent the frustration for you. I want to make sure that as you're getting going, as you're getting things moving, as you're looking for funding, that you don't go out there, hit your head. We want to make this as smooth and easy as a process as possible for you. So the first thing we want to look at, let's get inside the head of a lender, because that to me is when you can think like a lender and you can understand where they're coming from, it gives you kind of an unfair advantage. So the first one, contrary to what anyone says, the goal of every lender is to create loans. Banks do not make money if they're not lending money. We're seeing the Fed going out and raising interest rates, and the reason they're raising interest rates is to make more money and to curb inflation. But on the flip side, loans are how banks make money. So if you're not familiar with the structure of the concept of it, like us as consumers, we deposit money into the banks. The banks take that as a pool of money. It's FDIC insured, but they take that pool and then they loan that out, and then they get a return on the investment. And then that return is how the banks make money. So their number one goal is to create loans. That's what they want to do. They're not looking to deny you. They're looking to approve you. They're looking, how can I give you money? But the second thing that they're looking at almost exactly equally is protecting the bank's assets, protecting their assets, making sure that they're mitigating their risk, making sure that they're not writing paper that's gonna bite them in the future, working to make sure that everything's in order and that they're not taking unnecessary risk. Because part of it is, when you start looking at lending, you start looking at how banks operate. If there's too many bad loans, actually they can lose their charter as a bank. They can lose the ability to even have banking services. So that's something that's critical for them. They have to maintain that to protect their customers and to protect the business. And so part of the ways that they're doing that is determining your credit worthiness. Wow, credit worthiness. How worthy are you of credit? Are you a risk? Is it something? Can you prove that the business can repay the debt? Can they prove beyond a shadow of a doubt that the business has what it takes, that you've got everything in order, that it's relatively risk-free for them? And simply put, they don't want to be scammed at all. And so that's what we're going to do is we're going to help you prepare everything, get your books in order, make sure you've got the paperwork, you've got the forms that you need to be able to start applying for business loans the right way. So the first thing that lenders are going to be looking for, and we've covered this a lot, but it's so critical in the process, is your fundability foundation. Your fundability foundation is the foundation of your company, how your company is structured so that it's fundable, so that you can get money, that you can get revenue from it. With the fundability foundation, they're going to be looking at the address of the company. They're going to be looking at the email, phone numbers, website. Well, we're going to do email twice, so website and email, and the business structure. So these are all part of the essentials, and then they're going to look at the owner's information, how much you have, business license. Now, if you stop and think about this, and when I first was introduced to this concept and this credit suite, we've been working this out, really fleshing out the concept of fundability. At first, I was really looking at this, and I was like, this kind of doesn't make sense because this, it doesn't, it just seems a little tedious for what a bank would want. But then I started looking at my buying habits, and without even thinking about it, unconsciously, I would look at it. And if I got an email, if I reached out to a company and said, "Hey, I'm interested in this product you have for sale," and I got a email back from joespool@gmail.com, I wouldn't do business with them. I didn't have that level of trust with them. And the same thing, if I would go to a website and it wasn't secure, it was spammy, it wasn't even there. If their phone number just goes to a generic, T-Mobile voicemail, all these different things play into the confidence of buyers, but not only buyers, but also lenders, and maybe even more so lenders. So as you're getting your business started, if you're looking at this, if you're in the beginning phases, or maybe you've been operating a while, you're ready to get serious about financing, you've got to check out your fundability foundations. And again, that's going to include the address, making sure that you've got a physical address, not a PO box. A PO box is great for getting mail. It's very accessible. It's easy to get to, but it's not what lenders are looking for. They're going to want to see a physical address, having an email that's the same as your website. So we have info@creditsuite.com. Our website is creditsuite.com. That's what lenders are looking for, the structure of the business. They don't want to see sole proprietors. If you're operating as a sole proprietor, this is something that you're going to want to get an LLC at least. S corp, C corp are all great information as well. Are great structures as well. And then the owner information. They want to make sure, they want to see all the owners that are involved, who has equity, who has stake in the company. And business license are actually really helpful as well, because it shows that you're taking the proper steps to be licensed in your city, your county, your state, and wherever you need to. Some industries have specific licenses that are required. That's what they're looking for, is make sure that everything's in order, make sure that everything's taken care of. Now, on the technical side, now we've got through the fundability foundations, and we won't really touch on that again until the end when we're recapping. But let's get into some of the nitty gritty. What lenders are looking for to mitigate their risk first is verification of revenue. They want to be able to see that your business is making money. Sounds smart, right? Kind of makes sense. Expense reporting. They need to know how much money you're spending, where that money's going, what those expenses are being used for. Verification of assets. Do you have savings accounts? So we're going to break all these down. We're going to get into this more in depth with the reports that go with them. And then business plan and growth projections. Are you growing? What's your plan for growing in the future? And then personal financials. When you start getting in some of the bigger loans, SBA loans, traditional banking loans, they're going to look at the business owner's information. Now, I'm going to take a little bit of a rabbit trail here for just a second, because this is something that we here at Credit Suite, we always talk about being able to get financing or be able to get funding without a personal guarantee. As your business gets going, the reason that banks, and you're looking at hundreds of thousands or millions of dollars in lending, The reason banks will look at the business owner's information is there are debts that you may have that compromise the integrity of your business. This can include tax debt, it could be student loans, it's going to be mostly government-backed debts that would be out there. But they have the ability to pierce the corporate veil, step in and just take the money without any recourse whatsoever. And so a lot of times when you see, personal financials, you see personal guarantees, things like that, the reason that banks are doing that, again, one, they're mitigating their own risk, but the other side of it is they're making sure that if they give you $1 million in funding, that money is just not going to be come in and taken out because of a lawsuit, or anything like that you're personally liable for as well. So just something to keep in mind while you're going through that. And with the personal financials, they're going to be looking at your credit, they're going to be looking at income versus expenses, assets, all sorts of stuff. So let's start with the verification of revenue. Simple question. If you can answer this question, then that's great. That's really the name of the game. Is the business making money? So the verification of revenue, what lenders are going to be looking for is income statements or a statement of revenue. And guys, as we're going through this, understand these aren't exclusive, these aren't hidden documents, anything like that. Almost every single thing that we're going to be talking about today can be found inside of QuickBooks, Peachtree, any kind of accounting software is going to have this. This is actually how corporations run their businesses. They're looking at their income statements. They're looking at the revenue statements. They're looking to see what their cash flow looks like. So this is a good practice as you're moving forward and as you're looking at funding, to be able to get to the point as the owner, as the CEO, to be able to examine what's going on, where the business finance is at, how does our revenue look, and start using what banks are using to determine the health of your business on your own. So banks are going to be looking at income statements or statement of revenue. Profit and loss statements are huge. That's a big one that they're going to be reviewing. They're going to look at cash flow statements. How much money is the company bringing in? What does it look like on a consistent basis? It's also included in that's going to be balance sheets. They're going to look at your business bank statements to be able to verify that what you're saying them is accurate and true. And they may also look at merchant account statements. Now, part of the reason for this is, and like I look at this, I'm like, well, why would they need my merchant account if they can see my business bank statement? Because part of what they're taking into consideration is when you're using a merchant account, you may have a 2.5-3% fee on there, that's included as the cost of using the merchant, and they're able to look at that, back that out. But the other side of it is they want to make sure that if you're running $80,000 and you tell them, look, all of our money is coming in from a merchant account, that they can account for all that money that's going into the business bank account through that merchant account, and vice versa. They want to make sure that it's just protecting themselves, looking for any irregularities, anything that may really put them in a position that they just don't want to overlook anything. So with the verification of revenue, lenders are also going to be looking for, oh, looks like I duplicated my sheet there. They're also going to be looking through your business bank statements, merchant statements, and accounts receivable. So invoices. Do you have, what kind of invoices are you running? How much are outstanding? They're going to be looking at how you're making money and and then next they're going to be looking at your expense reporting. Not only are you making money, but what's the bottom line? Where is that money going? How is the money being spent? Brian Funk says, don't forget the amount of chargebacks as well. That's a great point, Brian, and you're jumping a bit ahead of me. I love it, but that's actually what we're talking about in the expense reporting. So with expense reporting, lenders are they're going to be looking for your business tax returns. They want to see documentation of what you submit to the IRS. They're looking for monthly operating expenses. So how much money are you paying? What are you spending your money on? Where is the revenue going? Is it producing money? They're looking at your monthly payroll. How much are you spending in taxes? What is your liabilities? What do you know that you're going to have to cover every month? And then, as Brian mentioned, accounts receivable attrition rate. What's the chargeback? How much are you actually collecting? Are you losing money in your accounts receivable or your invoicing? And then basically what they're doing is they're doing a comparison. On the consumer lending side, they call it your debt to income ratio, and it's basically the same thing on the business side. They're looking at your revenue versus your expenses to figure out, okay, how much cash does this business have to operate with? And that's an important thing to keep in mind, because think of it this way. You may have great cash flow, But if your expenses way outweigh what your cash flow is doing, then you're not solvent. You're upside down in your business. You're upside down. You may have great revenue, but if your expenses are way outside of what your revenue is doing, then you're still upside down in the business. And that's what they're looking for, is making sure that with your monthly expenses, with your monthly income coming in, that you've got the ability to repay a loan, because that ability to repay is going to determine if they're going to qualify. Next thing that we talked about is asset verification. Determine the company's net worth. They're going to be looking at outstanding invoices. And this is something that's important as well. The outstanding invoices are also going to include, are there uncollected invoices? Because there is AR financing out there for outstanding receivables that haven't been collected. They're going to look at owned equity. Does the business own equity in other businesses? Are there other ventures? Are there other things that's involved with that's creating revenue? Then it's going to look at the business assets. Do you have stocks? Do you have bonds? Do you have mutual funds? Is there equipment that you've invested in that you've got equity standing? Do you have real estate that's available that you've got a good equity position on? Or do you have inventory? You may be running a retail store and you've got a ton of inventory that are sitting there. All of these assets are going to be important because, one, it's going to determine the net worth of your business, but it's also going to make it where they can determine that, if things get dicey, if you go through an economic downturn or the business hits a rough patch, are there assets that can be sold off, that can be liquidated in order to pay off the loan, or at least at a bare minimum maintain the monthly payments? So that they're going to be looking for that within the asset verification. And while you're getting ready for your loans, what you could be doing is looking at, what are your reports? What are your outstanding invoices? Do you have evaluations on your equipment, on your appraisals, on your real estate? All of this documentation goes a long way with smoothing out the process for getting approved for a business loan, and really making sure that you have what lenders are looking for. The next thing they're going to want to see is a business plan. Will the business have growth? That's really the bottom line for them. Business plan. Can you consistently show past growth? Businesses love, or banks love to work with businesses that are on fast growth plans. Within the last week, we saw Brex on the business credit side just basically come out and say, hey, we're not going to work with traditional small businesses anymore. We want to work with ones that have that high trajectory for growth. And that's, they've got financial backing, they've got loans, they've got investors, all these different things. But banks are looking at that as well. Have you consistently grown? Because let's face it, none of us would be willing to lend money to somebody who said, hey, I made $100,000 this last year, but the year before that, I made 200,000. You'd be looking at that going, your income's kind of on a downward spiral. Loaning money to you may not be the best idea because it looks like you're starting to get in trouble. Banks are looking at the same thing. If your business isn't growing, I think we called it the Red Charlotte. I don't know. We were actually talking about this morning in one of our meetings, and it was really good. It's basically it's the fact, if you're not moving forward, you're moving backwards. In business, there is no stalemate. There is no treading water. You have to constantly be moving. Revenue and growth are how you determine the success of a business. So if the business is growing, that's what lenders are looking for. And then what are your future plans for growth? What can you put in place? What's your strategy? What are you going to do to reach more of the market? And is it a realistic model? Is it sustainable? Is it something that you can do? Because you can go to a bank and say, look, I'm going to do this cold email campaign and I'm going to get millions and millions of clients all at one time. And they can look at that and go, that's not a very realistic model, and it's not sustainable, because even if you could get millions, you can't service them. They're smart. They're business owners. Their whole job is to analyze businesses, to analyze loans, and determine if it's safe for the bank, if it's something that makes sense. And then the other side, is your growth cost prohibitive? Like if you're let's say you're running off of on startup mode and you're operating with 1099 contractors, does the cost of moving everybody over to W-2 employees, is that prohibitive from what the company is actually making? Is that something that on a percentage growth that you're not going to be able to offset? So these are all things that they're looking for. We just shared inside of the chat, we have a YouTube video that ties done on this with the business plan. And this YouTube video is awesome. It actually goes really, really in depth on the different types of everything that's broken down inside of a business plan. And it goes very, very deep. And it's actually made for investors, but banks are typically basically investors as well. So it's a great thing. It's a great video. When you get a couple minutes and we're done here, go check that out. It's on our YouTube channel. So it looks like we've got a couple other comments here. Hello from Nebraska. Brian's here again. The biggest thing I found is do you follow your business plan or moved away from your initial goals? That's a great point, Brian. If you have a business plan, stick with it. Banks love to see consistency. They love to see growth. They love to see that you have a plan and that you can execute the plan, because a plan without execution is just a waste of paper, basically. The next thing that lenders are going to be looking for are your personal financials. Are the owners financially stable? This is a big one, guys. You know, as much as we want to avoid personal financials and personal guarantees, banks want to see it. They need to make sure that you, as the business owner, are personally financially stable. Now, one of the things that one of the mindsets, and if you ever have a chance to sit down to talk to a banker, it's a great thing to do. I would recommend, you know, if you're really serious about getting money for your business, take a banker out to lunch, get into a networking group, find a banker, take them out for coffee, and just talk with them, understand their mindset, understand where they're coming from, and will help you to structure your business and operate it in a way that makes it fundable. But a big thing to understand is that when a business owner is financially in trouble, or is starting to go under, or is struggling financially, they make irrational decisions with their business because they get into oh crap mode, where now they're looking at, how can I bring in as much money as possible in the fastest way possible, and they tend to make bad decisions. That stability of the business owner themselves is one of the key components that banks want to look for, because they know that if the owner is stable, then you're going to make long-term, long growth, smart decisions with the business most of the time, and instead of making rash, quick profit decisions. So what the banks are going to be looking at is they want to look at your personal tax returns. So you're going to have those done to qualify. They want to see your income. They want to see if you're making income from the business, if you're bringing in income from investments, if you have a 9-to-5 job, a W-2 position. All of that stuff is going to be taken into consideration. They're also going to be looking at your assets. Do you have stocks, bonds, mutual funds, 401k plans? If you have vehicles, if you have real estate, they're going to be looking at all this stuff that you may have personally to see. The other thing that they're going to be looking at, though, is they're going to be looking at the assets of other businesses. Do you have ownership in other businesses? Now, when you start getting into traditional bank lending and you start looking at SBA loans, one of the things that most people won't tell you is that when you have ownership in multiple businesses, the banks have every right to ask for the financial statements, all of this information and documentation in these other businesses as well. Because what they don't want to do is they don't want to lend you $1 million, and you know, company A is taking that $1 million and trying to bail out company B. They're not into that. That's not what they're looking at doing. So that's part of the reason they're going through your personal financials as well. Is your company may not have equity in another company, but you as a business owner may have equity in another company that's failing, and you want to leverage company A to bail out company B, and that puts an extreme risk on the bank, because now you're not investing for growth, you're investing to save yourself financial trouble and to kind of bail yourself out. So that's something to keep in mind as you're going through this. That's one of those assets that you're going to have to disclose. They're going to want to see your expenses. They want to make sure that you're not upside down, that you're not underwater, and they want to see your credit. They're going to check your credit with TransUnion, Experian, Equifax, the major three, but they're also going to look at a couple other places: LexisNexis and ChexSystems. LexisNexis is where all your public records are stored. So if you have any UCC filings that may be hiding, which UCC filings aren't always bad, that's not always a negative thing, but they want to see that. It's something that they're looking for. But they're also going to be looking for, are there any public records out there against you? Are there any judgments? Are there any tax liens? That's really what LexisNexis is for. And ChexSystems is just to make sure you don't have any bad checking accounts out there, that your banking history, because again, if a bank's going to be loaning you money, they want to see how you've properly worked or how you've handled yourself with other banks and other institutions. So there's kind of 5 different places that they're going to be checking your information. And the last one, and I love when Ty tells this story. It cracks me up every single time. Is your criminal history. When you're when you're looking at loans, especially like SBA, they're going to ask you, have you had any felony or misdemeanors in your past? And I mean, I don't know many people who don't have some sort of misdemeanor that, speeding or, it just, you make a mistake and you get a ticket or you have to go to court for something. It just happens. But they want to see they're gonna take a look at your criminal history, and you need to be able to disclose it. The other side is, if you know that you're up against some financial obstacles, don't try to hide them. The more open and transparent you can be with the bank, the more that you can, during that initial process of getting started, the easier it's going to be for them to look at the solutions and go, hey, you know what? Your personal credit is really shot. It's bad, but your business credit looks good. And now we can offset your personal credit because of your business credit. Again, the first thing that banks want to do is they want to make loans. A loan officer doesn't get paid for not making loans. That's their whole job description. It's the name of the position. They're a loan officer. They make loans. They're going to look for ways to be able to approve you and work with you to find ways that mitigate the risk to the bank, plus make it able for them to loan you money. So they make money, you get money. It turns into a win-win for everyone. So if you're dealing with personal financial issues, be upfront, be honest, disclose them. Don't be afraid of them. Talk with the bankers about it, and then ask solutions. Because here's the thing: you may be looking at a traditional bank, and you may be looking at an SBA loan. You may be looking at some of the products that are out there that have the absolute best rates and terms, that have the lowest fees, that have the longest financing terms. And it looks wonderful, and that's what you're shooting for, and that's what you should always aim for, because financially it makes sense. But then once you get in there, being open with them may make you it will give you the opportunity of finding out what you need to do to be able to get approved with them. But then it opens up the opportunity for alternative lending. So let's talk about some of the red flags to avoid. So as you're getting into this, these are some of the issues that can cause funding problems. Document issues that can cause funding problems. Major red flags. Not being profitable is one. Don't try to move numbers around. Don't try to squeeze things out. I've got a book up here, and we've talked about this several times. It's called Profit First. I'll share this with you. It's called Profit First by Mike Malkovich. It looks like it's backwards on my screen. Sorry about that. But it's a great book. I've read this book multiple times. We actually do a lot of training on this within the company, within Credit Suite here. But it does a great job of helping you to make sure that you set up your business for profitability. That's what your business is for, is to make a profit. That's why we run businesses. That's why we are entrepreneurs. We're driven by money. We want to make money. Being profitable is the first thing, but a major red flag for any bank is if you're not profitable, because they're looking at that profit as your repayment for that loan, because anything that's not a profit is an expense. And so they're looking at that profit as, this is your disposable income. So at the end of the year, let's say you have $250,000 in profit that you're distributing. That is disposable income. That's money that the company or you as the owner can decide what to do with. If you're not profitable, you don't have that disposable income, meaning that banks are going to look at it and go, I can't really loan you money because you can't prove that you have the ability to repay it. Not having cash flow to pay your obligations. This is where business credit comes in. Making sure you've got a strong business credit history, that your payment history is spot on, that you've got the cash flow to pay for these obligations, that you don't have things that are outstanding. And look, I get it. As a business owner, we get running 90 miles an hour all the time, from the time we wake up to the time we go to bed. And then when we're in bed, we start having dreams about our business, and we miss things because we're always moving 1,000 miles an hour. While you're doing that, if something happens, if you miss a payment, be quick to correct it. Don't just put it off. Just don't. Oh, I have a small checking account over there. It's it's negative. I'm just going to leave it, or you just forget about it. As soon as you see an issue, address the issue, get it resolved quickly, because it's a lot easier to explain to a lender, look, you know what? I made a mistake. There was a hiccup. I just missed it. I corrected it as soon as I can. It goes a long way. The next thing, excessive debt. If you have a bunch of loans, lenders don't like loaning to people who already have a bunch of loans. Part of your strategy may be, look, I'm looking for better financing so I can pay off some of these short-term, these short cash loans by consolidating them into this longer loan, plus giving me growth capital for moving forward. Excessive debt is something that you want to avoid. The next one, not having documents, not having your profit and loss statements, your balance sheets, not having these things in order is really going to put you at a disadvantage, because if you can't show the bank what the bank's looking for, then it's not provable. And that's really it at the end of the day. You've got to be able to provide what they're looking for. And that's really what we're talking about here. And then not personally be insolvent. If you're upside down personally, again, it poses a high risk to the bank. You start making decisions that usually aren't the best for the business, and it gets into a cat and mouse game where you feel like you're always chasing a solution if you personally are struggling. Some of the not so obvious issues. These aren't major red flags. Let's just call these orange flags because it makes sense. Inconsistent information between documents. This gets back into fundability. Having your address wrong, having your phone number different, having different websites, all these different little tiny things. Those inconsistencies raise red flags, and they raise the orange flags for the lenders, because they have to go back, they have to double check, they have to verify and make sure that things are accurate. Name spelling is a big one. Make sure your name's always spelled the same, different contact information. Not having all your licenses or certificates. Don't cut corners. When you're looking for money, banks don't cut corners. They don't want to see you cutting corners either. And no separate business bank account. That one, I think we could have moved to a red flag, but still, always have a separate bank account for your business. And here's the thing: when lenders are looking at it, if you're running business funds into a personal checking account, they don't even count it as business funds, even though you have to on your taxes. But at the end of the day, they're going to look at that and go, you know what? You didn't have it into a business account. It wasn't actually controlled by the entity. It's not the entity's assets. It's your personal assets. So make sure you have a separate bank account. It's a big one. So basically, any of the missed fundability steps, anything that we covered at the beginning. And if you missed that, go back, rewatch it. It's about 30 minutes into this. It's not real long, but those fundability steps go a long way. Making sure that you've got your fundability in order is by far the first step in all the process, because again, we're reducing those red flags. We're making it where they don't feel like they're being scammed. They're seeing consistent information. You look like a legitimate business. You operate like a legitimate business. Because you are a legitimate business, now what we're doing is just proving to the banks that you are a legitimate business. Some of the other things, business address is a PO box or something similar. Again, you need a physical address that can receive mail. Why do you need a physical address? Because worst case scenario, a bank needs to serve you. Something comes up, there's a dispute. They need to be able to know where they can go to be able to contact you at all times. That's why the physical address is so important. They want to know that there is that they can reach you, that they can find you if they need to talk with you, to get in touch with you, to make sure that everything's okay. Most lenders are going to accept virtual addresses with this, especially as time moves on. Since the pandemic, this has really loosened up, where a lot of lenders they don't even care anymore about the virtual address, because there's so many remote working from home companies and companies that operate in that remote status. Business not having a toll-free number could be a red flag for them. Business number and personal number are the same. Have a separate business phone number, have a separate personal phone number. Now, look, guys, when it comes into business phone numbers, it's not that difficult. Companies like RingCentral, Vonage, places like that, they've got apps that will go onto your phone. Again, it says business number and personal number. It doesn't say device, it says number. You can have your iPhone, you can have your Android, and then have the app for the business on there, so that way you've got your personal phone and you've got your business phone all in one place. It's just separate numbers. They can verify that the business actually owns that number, that it's a business number or it's a personal number, giving them that peace of mind that they're looking for. So here's some of the tips for success. Recapping what you need. Have the commonly requested documents ready. Ensure that all your documents are complete and accurate. Make sure all information between all your documents is consistent. Congruency is the key. And one of the big ones, the biggest one I can give you is work with the professionals. Have a CPA, have a good, solid working relationship with the CPA to streamline the process. And then good software will keep you on track monthly. Use something like QuickBooks, use Peachtree. Talk to your CPA, talk to with your bookkeepers, your accountant. What is it that they want to see that you can use? And then just incorporate it into your operations. Use that as an ongoing process moving forward, is making sure you've got everything there, making sure that you're using your software to the best of its ability. Um, the next thing is where to start. Find out what you can get if you want to find out what you can get pre-qualified for now, give us a call, 877-600-2487. We've got a whole team of people that will sit down with you, figure out what your financial strengths are. They're going to help you know what the lenders are looking for before you apply. They're going to help you leverage your strengths so you can find the best options now and create a strategy to qualify for the best options moving forward. Basically, you're going to have a team with you that you never have to look for funding again. You'll have access to business credit options, all sorts of great tools and resources that we provide our clients. And best of all, it's all in one easy to use software platform. Takes the guesswork out of everything for you. If you have questions or you need help with this, give us a call. Again, 877-600-2487. You can go online to creditsuite.com or email us at info@creditsuite.com. Send us smoke signals on social media. However you'd like to reach us, we're always here to help. We love talking with you, helping you figure out what you need and how you can move things moving forward. So again, if you need anything, reach out. We're always here. Other than that, have a great day. I look forward to seeing you guys at the Funding 30 Challenge. Again, if you haven't registered, it's funding30challenge.com. Look forward to seeing you there, and we'll see you guys next time.